Expectations for inflation rising in October, that according to the University of Michigan, which is a closely watched indicator for Fed officials, by the way. It follows yesterday's hotter than expected CPI report for September. But in a new CNBC op-ed, our next guest says there's plenty of evidence that prices are actually falling across the economy. Ron Insana is CNBC senior analyst and commentator. He's also senior advisor to Schroders North America. He joins us now with his deflation checklist. Where are you seeing it, Ron?
Disinflation checklist.
Disinflation, not deflation.
I'm not ready for deflation quite yet, Tyler. But listen, I think there are a whole host of areas where we're seeing goods prices begin to fall, inventories accumulate. We're seeing shipping times and shipping costs fall rather dramatically to pre-pandemic levels. And so on the goods side, we're already seeing disinflation for a lot of different items. And I think that's important insofar as it will eventually feed into both CPI, the headline number, and the core. And as you mentioned earlier, in residential real estate, places like Los Angeles even, prices are beginning to come down. And that's true in major metropolitan areas. Rents are lagging, but will eventually get there and start to put downward pressure on CPI as well.
So do you think that the Fed is paying sufficient attention to these indicators that you cite, which are more present and forward-looking than the numbers that are in the data that, for example, that came out yesterday or the day before, which are backward-looking?
Right. No, 100%. I think they're looking in the wrong direction insofar as, you look at the New York Federal Reserve's own, a global supply chain pressure index that has turned lower, again, with respect to a lot having to do with global trade, with respect to shipping times, container costs, which last year were, $20,000. This year, they're $2,300. And so we're seeing, all that supply chain disruption evaporate. Retailers, as we've discussed in the past, accumulating large inventories and are going to have to discount prices going forward. And, even commodities, look at gasoline and oil, after that brief OPEC pop that we had a couple of weeks ago, we're back down $3 today and falling. And so gasoline's going to start coming down again. And so I really think that the market, whether it's inflation expectations away from the University of Michigan, which have ticked up a bit, but are still very well anchored around 2.3, 2.4% when you look at Treasury break-evens and the like. The market's telling us inflation's coming down.
Yeah, okay, but Ron, where we saw the problem is with services inflation and wage inflation. How do you think that you start to see a disinflation in those areas?
Well, Liz Ann Saunders of Charles Schwab put up an interesting chart just a little while ago, and it showed that wage inflation is beginning to roll over as well. And so when you see that, which is what the Fed's trying to break along with the services numbers will have to come down if the economy slows. There's just no way you can maintain a higher cost of services if the economy were to slow significantly, or even in the words of Jamie Dimon, we slip into recession.
And do you think that it kind of propels automation here? Because I've read this, that in the top jobs in every state, 2 of the 3 are drivers and cashiers, both of which have the potential to have automation come in and be disruptors in those sectors.
Well, cashiers already.
Yeah,
I mean,
look at McDonald's. Right.
Yeah. And McDonald's has robots making fries, or at least is experimenting with that. Amazon has a robot that can load 1,000 packages on a conveyor belt per hour. So, it's funny. I did talk to Kathy Wood at an investor conference a couple days ago. She's on the deflation side of this with innovation. I'm on the disinflation side. But I do think with artificial intelligence, machine learning, robotics, natural language processing, all of those things over the next year or two are going to come at the economy faster than people realize, and will help at least go some way in solving some of the wage issues that we have today.
I thought it was so interesting yesterday, coming off of, I know you and I were both in Las Vegas, but at separate conferences, to watch the speculation over the markets and why we were seeing the sort of rash turnaround. What's your thought about this? Like, we need to buckle up and get ready for more of that?
Yeah, probably. I mean, and it's interesting. Larry Summers, with who I've openly disagreed on this inflation issue and on Fed policy, is now talking very openly about emerging market bonds breaking and that developed nations are not doing enough to ward off a 1997 or 1998 style emerging market debt crisis. If that's true, and if the Fed's getting closer to raising rates to 4.5% or 5%, something will break and we'll see increased volatility. So, it's interesting that Larry's been pushing for higher rates, but now also warning of the consequences of going too far too fast, because some bond markets what Japanese government bonds, 10 years, haven't traded for like 5 days. And the illiquidity in the UK, and we're seeing this also in African bond markets. You know, a mistake there, and you know, the Fed has to stop.
Ron Insana.
Insana conferences in Las Vegas? Conferences?
Yeah. Did I just, I just gave fodder to the...
She was at a gaming conference. I was at a financial conference.
Guess which one was more fun?
Yeah. Well, no, I had a great time, actually. I mean, I lost a couple $100, but...
I walked away a winner. I tripled my money.
Did you?
Ron Insana. But in the game, I cover gambling as
the next time
I cover gambling as a sector. I should know something about it.
I'll be in Vegas next week again.
You will? Okay, let's talk.
We digress.